Okay, so that's this is the recording of our next session, which is the trade sale process. And this is going into our weekly discussion library. If anybody wants it, you can access it. It's on YouTube. It's private, but you guys can get a link to it. It should have a link to it, but if you need it, let me know and I'll give it to you again. So why do we need an exit? Well, sometimes the projects that you do that you've been building on doesn't quite fit your organisation or your skill set. You want to get rid of it. Sometimes it requires more skills and resources than you have available. And if you can sell it to another party so they can go and develop it and they've got the resources to do that, that's not a bad thing if you can make some money from that. Normally we look at either a license or a trade sale. License is where you want to keep some semblance of participation. A trade sale is where you want to let it go. So the price depends on the value that you put into this that you can realise. So sometimes that value is perceived value, and we have to engineer a pitch in such a way that we can show that value. Ideas don't have any value. So if you've got an idea and you want to sell that idea, good luck with that. It's not likely to happen. So now, if we wanted to, we can sell the technology to another party and get them to do something with it. But the key here is, how do we find that party? So what I want to do is to help you profile that party. And then when you have found them, what do you pitch? And finally, how do you get the very best price? Now, in a lot of cases, to get the very best price, you already have the tools at your disposal that you've used in funding and licensing. I'm going to show you how they apply to these. So the 4 key points in the process is how to identify the parties who'll pay the most for what you've got. And it's easy. We use the same 10-4-1 process that we do for funding, for partnerships, for licensing, for distribution. 10-4-1 will give you the top 10, gives you 4 qualified, and then you pitch the first one and get one of those to buy. So, and you go up to 4 pitches, but generally you wouldn't have to go to 4 pitches. Now, the whole idea is you can remove their risk, and you can prove it with, you have to be able to prove that you can remove their risk with things like patent advantages that they have. And therefore, if you've got a client, a prospective buyer in the USA, and they don't work outside of USA, and you've got a global patent, then you would only sell them a USA patent and keep the rest. Or if you've only got a US patent, that's pretty much what you're doing. So, and when we've done all of that, we use our same 12-point pitch. There's a few minor differences on some of the pages. And we also use the same leverages to show them what the value is that they're buying, that's an undisclosed value over and above that will add to their bottom line as a result of that relationship. So, and we also want to be able to test the cashless transaction and use, once you've done that with our script rollover and things like that, we'll also layer on another version of options. We talk about 50-20-20-20 or 50-25-25-25. So in terms of percentages, how we can make the value of that be more than 100% of agreed value. So I want to see also that for the cashless transaction, starting with that, public company, what we want to do is get a public company. We don't want to deal with the private, because that doesn't give you the scope to sell readily. You can only sell to certain people with a private company. So you want to make sure that they are either public now or they've got intent within 12 months. I don't like to use companies that promise me an intent, because I've had a client who actually, we did an aggregation of property rent rolls across Australia, and we put it into an IPO, a public listing, an initial public offer. And then this guy delayed it so he could buy more at a discount and put them in himself. And he was building his wealth doing that. And of course, he's killing everyone else's investment. They were locked into this, so it became very problematic. And the guy just got so greedy with it that eventually the guy that put the capital up got together with the end owners, some of the guys who were getting upset. And instead of, he put in 500,000 to get this to a listing, he ended up putting in another 1.1 million to actually take it from the original guy to put the listing through. So he got his money back as well, and everyone else did. So it became a real problem because I had to work against the client that I had in order to save everyone else. And that's not something I want. As a postmark to that, that guy has been charged by ASIC under another project that he did since then. So I'm kind of a little bit vindicated on that. Now, with the cashless transaction, we start with what's called script for script rollover. Essentially what we're saying is you have maybe 10 shares in your proprietary limited company or your incorporated company, and we're going to find a buyer who's going to give you, let's say, $1 million worth of shares, if that's your value you've agreed on, shares in his company as a public listed company. And so that means you give 10 shares, he gives you $1 million worth of shares. Let's say they're $1 share, $1 shares, he's giving you 1 million shares. So nice exchange. But in fact, when that happens, you won't actually have a tax event because you're not selling anything. All you're doing is swapping. That's a key thing for later on. Now, if you want to get $1 million, fine, and that's agreed by both parties. But if you want to get $10 million, you're almost never going to get it through the auditors if that's the price. If it's above the market value, auditors will crush it because they act for the shareholders and they will not approve what the directors approve. So understanding that this whole concept has 3 levels of approval now. The line manager who wants this product, the C-suite / directors, and then the auditors. And so to get it through the auditors, they're going to have to justify on behalf of the shareholders, not on behalf of the managers or directors. So, and what we like to do is then settle for something like 50% at settlement, and then 25%, 25%, 25% over the next 6 months into intervals, and make that subject to KPIs or milestones. So that's important that you're saying to them, I know this is worth more. You can't see that, but give me a chance to prove it. And I'll take a holiday. I'll take a cut at the beginning, but if I meet all these KPIs, I want you to pay the full price. And they're not taking any risks. They're more likely to agree to that. And the auditors will also agree. So then you've got issues like voting rights on both sets of shares. How does that work? That's something you negotiate out. I don't want to get into that, but I do say that you have to address that. So then we're looking at that. You've got your 50% up front and you might get 25, 25, 25 in shares, but you also might get a bonus of options, or it could be 50 and then 25, 25 and then options. So options work by you setting a value that the buyer company will exceed as a result of your efforts or your promises that they're going to do. And then if they do that, you're giving them a discount for that risk, but you want to set an exercise price on the options. So it might be that their shares are worth, let's say, $1, and they're giving you $1 million worth of shares. They're going to give you $500,000 up front, $500,000 in 6 months, or over the next $250,000 in 6 months. In 3 months, $250,000 in 3 months, and then you want $500,000 worth of options exercised at the $1 price in 12 months with a 3-year exercisable period. And that gives you the right to buy more shares at $1. If the shares have gone to $2, it's worth you taking $1 for each of those shares, buy them, and then sell them for $2. So it's quite a good deal if you do that. If the shares go down, those options don't have any value to you. So usually they won't issue them at the $1. They'll issue them at $1.20 or something, $1.50. They're saying if you're promising to get our share price up as a result of this, and if you meet your KPIs, that will happen. And therefore, we want to give it to you at a higher price. And you won't mind that if you can be assured that you can get that higher price as a result of building the value for them. Now, have to know that you can control what you're doing in going forward, because they could be really good managers of your project and kill off everything else in their company. And as a result, the shareholders punish them by selling off their shares cheaper, in which case your options are worth nothing. options expire. They're not forever. They usually run for about 3 years, and yours will be issued on day one for 4 years, but you can't start exercising until after 12 months. So, and you'd have that window to do that. So what that means is basically you're taking a bet with these guys to say, I think the shares will be worth more than $1.20 if they're worth $1 today, and I'm prepared to take half of my money in and pay $1.20 per share from your company, and if they're worth more than that, then I'm going to clean up. So I want, basically, you can ask for an equivalent price in options, and let's say another 1 million options, and go that way. So it still gives you, maybe if it goes up by 25%, you're going to make yourself 25% of that. So it's only $250,000 extra, but it's helping you realize the value you otherwise wouldn't have, because you're in a position where you've said, I want to do this, and you won't come to the right price, but we can work this out so you can agree that you're carrying no risk to do this. So now what it means is that you do this and you spend 2 or 3 years supporting them, and the share price goes into orbit, you should be rewarded for that. So you can have options for 3, 5 years, whatever you decide, or whatever they agree on, and then have those issued at the settlement, not later on. You want them at settlement. So now, so much of what we learn in funding, distribution, trade sale, etc., is applicable to this. So that's why we're in cohorts, in groups of 6. You'll get to see what other project owners are implementing in their own cash events. It might be funding, it might be licensing, but if somebody's in this and you're not planning on this, ultimately you need to know about this, because nobody sits on their project forever. What you want to do is, once it's reached its maturity, or it's no longer climbing at an exponential rate, then you want to dump it and move on to your next project. So in a case like this, you need to learn this. If only one member of the cohort is in targeting licensing, and you can't get them to make that decision until you reach the point where you've got you've done your ideation and commercial modelling workshop. At that point there, you can say, okay, now we know, most of you guys, of course, have done that, but now we're in a situation where we can make a decision. Let's say we've picked an exit. If that were the case, then everyone around you can learn from what you're doing and practice on it. And that's a really good thing for those of you who are looking at funding but want to know all about this for later. So gives you a chance to see how others are doing it, so you can adapt it to your project. And it also gives you an opportunity to contribute far more in terms of value to other members of your cohort, which is an important part of this. It becomes a brains trust. If you guys do contribute, you'll get a lot more back later on as people help you. So I hope you can understand that, and we can move that forward. And now, once you hit your cash event, you can double down and start going back and doing another one. And you might then say, oh, well, okay, I can start working on my exit now that I know how to do it, what I need. We've got plenty of other, in the exit section of the program, you've got a whole lot of videos on how we do this. But essentially, you've already done your 10-4-1, you've done your leverages, you've done a pitch deck, a 12-point pitch. This is the same for any of the 4 significant cash generating transactions. 1 or 2 slides do change, but nothing else. So don't feel what you're learning for funding isn't applicable for you if you're only doing licensing. It will help. So now, if you're getting stuck, or once you reach your cash event, you've got some money in the bank, you want to double down, you want to get increase the speed at which you're converting, then you can engage one or more IP mentors within our group, and you can buy a block of 10 hours and they can do the work for you. That includes me. I do that for people from time to time. Now, you pay for that. It's out of your cash flow, so therefore you're not actually feeling it from yourself. So, and that's why this continuity project for people who've been in it for 6 months now want to come in and do it for another 6 months. They want to expand their the rate. They don't want to do just one significant cash generating transaction. They now want to do a number of them. So this is your opportunity. So I now want to know what your next big action step is for this week, and we can start to build on that. But also for this 6 months, for the second 6 months, if you're planning on something for that, then we should look at that. Now, I'm going to stop the recording before we take notes, just so they're not recorded from each of you as individuals.